Hello, everyone. This is Lindsay Knopic, Marketing Manager with Multnomah Group. Thank you for joining us today for our webinar. A couple housekeeping things while everyone joins in. You are joining us for our ERISA Litigation on the Rise, an update for retirement plan sponsors webinar. Our presenter today is our Senior Consultant and Chief Compliance Officer, Bonnie Treichel. Just so you guys know, we are recording today's webinar, and the recording and slides will be available for you via email probably in the next day or so, so that'll come your way. And we do ask that you hold any questions you might have for Bonnie until the end of the presentation. We have some time carved out for some short Q&A once she has completed. So with that, I will hand it over to Bonnie and enjoy the webinar.
All right, thanks, Lindsay. So again, if you want to hold your questions till the end, feel free to do so. But if you do have any technical difficulties along the way, feel free to use like the function with your question pane to send those over, because I want to make sure that everyone can hear along the way and make sure that I'm actually remembering to click the slide. So feel free to use that question pane if you need it. So we have a full agenda today, an update on ERISA litigation, and by now you are getting the idea that ERISA litigation is on the rise. So I'm going to go ahead and kind of set the tone at the beginning with a little bit on political and regulatory landscape. Then from there, I'm going to jump into an overview of some of the litigation that's out there. So we'll start and talk a little bit about the large corporations that are sued. So they're the defendants in these cases. Then we'll talk about some of the newer targets to ERISA litigation. So the really hot topic, particularly this week, which is colleges and universities as defendants. We'll talk about some other new targets. And then I'm going to introduce kind of what I call a new concept that you probably don't hear on some of these litigation update webinars, and I call it conflicted messages. So this is really talking about the idea of some mixed messages you may feel like you're getting when you read the headlines of these ERISA litigation cases or complaints. So it's the idea that one case is saying, hey, do this. The other case is saying, no, do this, which is literally the exact opposite. So we're going to talk about, when you're reading those things, what can you take away as a plan sponsor? And then, of course, we want to talk about where plan sponsors have had success in some of these cases, because they're really, for a period of time when these cases started to be filed in the early 2000s, it was like lose, lose, lose for plan sponsors. But that's not always the case now. And we want to talk about where plan sponsors are getting wins and how that's happening and what that means for you. Next, we're going to jump into the Tibble decision that was heard in the Supreme Court. And finally, most importantly, the reason to stick through the whole webinar is to talk about best practices for plan sponsors, and then Q&A at the end. So as I mentioned, full agenda for you, so let's get to it. So what's the political and regulatory landscape out there? And, you know, I think that by now, obviously, you're getting the idea litigation is on the rise. However, I think it's important to talk about first, why is litigation on the rise? And specifically in this webinar, what we're talking about is in the context of retirement plan fee litigation. And we're talking, a lot of times this is in the excessive fee cases, but there's also other theories of litigation that are coming up now as well. So one of the things I'm going to ask you to keep in mind, and then I'll get to the political and regulatory landscape, is when we start to look at these cases, put on your hat of thinking about, hey, if I receive a complaint in the mail today, or a draft complaint or demand letter, how will I, as a plan sponsor or a committee member, be ready to produce all of my documents and say, hey, your lawsuit doesn't scare me, I'm ready for you, I've got all my documentation ready. So let's listen to the webinar with that kind of hat or lens to think, hey, these lawsuits don't scare me because I'm ready for it. Here's the documentation in my fiduciary file that I've got ready. So keeping that in mind, what's the political and regulatory landscape? You know, the Trump administration and the theme of the Trump administration has been less regulation. So unwinding of Dodd-Frank, which was, you know, the big package after the financial crisis, also delaying and dismantling of the DOL fiduciary rule, which we saw with that start of the February 3rd memo last year from President Trump. And if you follow along on the Multnomah Group blog at all, you've definitely seen that's basically all I write about is all the changes in the fiduciary rule and the ups and downs and pulling apart of that rule. So you're getting the theme, less regulation under this administration. And I'll leave it to you if that's good or bad. But there could be the thought that, well, with less regulation, you know, that's going to be good for us as plan sponsors. I would argue up maybe a different thought that with less regulation, someone else is going to step in and fill the gap. And I think that someone else who's stepping up to fill the gap when there's less regulation is always going to be plaintiffs' attorneys. And that's just a thought that I throw out, right or wrong, but a thought that I have. You can also see not only with the unwinding of regulation, but there's also the EBSA, and the EBSA is a division underneath the Department of Labor. But the EBSA, their enforcement is continuing to go down. So it's declining. If you look at the 2016 numbers compared to the 2017 numbers, it's declining in terms of the number of investigations that have been closed, and then it's also declining in terms of the number of civil cases that have been filed. So just some kind of food for thought at what you're seeing there. Also, you know, I think that staffing at the EBSA is also down. I heard a stat that it's down 17% from its peak in 2012. So again, just kind of some food for thought on what's the climate out there in terms of in this financial services sphere, where we are, less regulation. I would offer that that means plaintiffs' attorneys are going to continue in the future to fill that gap, and plaintiffs' attorneys are probably going to be a worse opponent than regulators in terms of expense and the outcome. So that's a brief overview of what the political and regulatory landscape is. As I mentioned, you know, litigation is on the rise. This chart just gives a real quick snapshot of what that looks like. This is taking a look at data from 2013 to 2012. This was something that Investment News had, where they did a compilation of some data Groom Law had put together. And you know, one of the things that we're seeing is that in the early 2000s, there were some really, really big settlements. And I would suggest that now we're not seeing quite as many of these, what I'll call mega settlements. But what we are seeing is that there's a lot of just, I'll call consistent settlements. So 25 million, 75 million. They're not extremely high, but they're consistent and they're increasing. So I want to think just a little bit more about why there's this increase in litigation. And I'm sure you guys have some thoughts. The thing I hate about webinars is that there's no feedback loop, so you can't raise your hand and offer up what you think. I can only tell you what I think. But here's a few of my thoughts, and maybe feel free to use your chat function if you have other thoughts as well. But you know, why, I think one reason why there is an increase in litigation is that there are new plaintiffs firms that are throwing their hat in the ring and saying, hey, we want to file these cases too. In the past, there was always, and when I say past, when these cases started in the kind of early to mid 2000s, there was one firm out of St. Louis that really filed most of these suits. Over time, we're seeing other law firms start to get involved and file these lawsuits. So what does that mean? It just means that there's more potential for these lawsuits because they can kind of, I'll call it, copycat or use the pattern that prior cases have set and file additional lawsuits. So one, new plaintiffs firms are entering the ring. Two, and we'll see this on the next slide, I think there's been, prior success for these plaintiffs firms. And when you see this next slide, you'll see, oh yeah, with the amount of money that these plaintiffs firms can make, given the way that the attorney's fees work, then yeah, there's a reason to get involved. And instead of doing the slip and fall case, this other type of work might make some more sense. One of the things about ERISA is that ERISA has a statutory provision that allows for one party, so the winner, to recover all of the fees in the case. So then when you think of if the winning party can recover fees because of the statutory fee shifting mechanism, and then the plaintiff's attorney, if they can take 25 to 40% off of that, can be a pretty good business model. Now, that's not to suggest that these cases aren't expensive to run. I certainly would suggest that as well, but it could be lucrative, which could suggest why the litigation continues to rise. The last reason I'll offer up for why we continue to see an increase in litigation would be just simply changing regulations. So as the regulations change, a door opens for increased litigation. Let's take the example of 408B2. So I think most of us on the line are likely familiar with 408B2, which came out, it started in 2012, and it said that that along with 404A5, that coupled together made fees much more transparent. That, to me, creates a reason for increased litigation because there became this heightened awareness of fees and fees paid for retirement plan services. I think another thought is that with increased technology, it does make it easier for these cases to get filed as well. So as I mentioned, I wanted to just give a really quick snapshot of kind of that concept of prior success for plaintiffs firms and why it might be, an advantage to do this type of work as opposed to a slip and fall case. Again, these are really complicated cases, expensive to run for a plaintiff's firm, but this is a snapshot. The source here was Bloomberg. They had some nice material on this, but this is one plaintiff's firm. This is a firm out of St. Louis that did a bunch of these cases and is really the leader in these types of cases. But this is not the judgment. This is just the plaintiff's attorneys from these cases. So you can see the total at the bottom. That's a nice sum of money. Could create some incentive for these to continue. So now that we've taken a look at, what's the political landscape, why are these cases being filed, and why might they continue to be filed, it may be helpful to just take a quick look at what are the targets and what are the types of cases that continue to be filed today. So as I mentioned, one of the traditional areas where these lawsuits were filed was against big Fortune 500 companies. So those were the original sets of 401k cases that were filed. And oftentimes with those cases, they settled. But, they're still being filed today against a lot of big companies. Maybe they're not the top 100 companies, but there's still really big companies that are facing these lawsuits. So what are the theories being filed in these cases, or causes of action, rather? Some of them are what I'll call the plain vanilla, same plain vanilla things that have always been filed, and some of them are a little bit more of a novel cause of action. I just picked two of these cases. There's a lot more out there, and I'll just give you a taste. But again, I want us to go back to thinking, if you were to receive a demand letter today that said, hey, here's a draft complaint, because this is what happens a lot of times. You'll actually get, you'll get a draft complaint attached to a demand letter. And it's essentially saying, hey, the plaintiff's attorney probably used publicly available data stuff from like a Form 5500 oftentimes. And they're really trying to kind of go on a fishing expedition to see if they've got a case there, or at least that's my perspective on it. So they're going to use this as an exercise to see if there's something there. Well, what I want you to think about is, what would you have in your arsenal or your fiduciary file from everything you've been doing properly, from a best practices, to be able to say, yep, I've received your demand letter, and you can call your attorney and get them to go away quickly because you've got your fiduciary file in order, and here's all the things you would do to defend against that case. So in the Nordstrom case, this was a case filed last fall. The real gist of it from my perspective is that the plan fees for the record keeper were going up over time when arguably, because a lot of us are aware of this concept of fee compression in the marketplace as a general matter, the argument was that fees were going up over time and they should have actually been going down over time. That was the argument. So really, what would you have in your fiduciary file that you could say, hey, I get that that's the argument, but here's what I have to defend against that. From my perspective, the types of things that you would want to have in a fiduciary file would be something that maybe shows the needs of the participants and the fact that the needs of the participants may have warranted an increase in services. You could also have something in your fiduciary file that demonstrates that the plan went out to bid once every 3 years via a formal RFP, or when I say RFP, request for proposal process, and that maybe these were the best fees you could get given the needs of the plan. Also, perhaps having something, for example, at Multnomah Group, we do what's called fee benchmarking with our clients. That's what we'll be doing with clients during the second quarter. And so if you had a formal fee benchmarking where you could paper the file and show that each year we did fee benchmarking, they were within an acceptable range because maybe they have some really complicated needs that warrant these fees, I think those are all fair things for the file. So that's just a little food for thought on the Nordstrom case. The next case is the CenturyLink case. Again, another class action filed last November. This one, I would say, is not as much of the plain vanilla. I'll call this one a bit more of the a novel kind of concept. So in this one, the plaintiff is claiming that there's underperformance, and that the underperformance was virtually just guaranteed because it contained, the strategy contained a serious design flaw all the way from inception. So because of this built-in flaw, it's really just attacking the strategy that was employed to meet the investment objectives. And as a result, plaintiffs have breached their fiduciary duty because they should have known. Again, a bit more of a novel argument, but if we go back to the ERISA basics, as I would consider them, ERISA requires a prudent process. So, ERISA is not saying that you have to choose the best performing fund. It requires a prudent process based on what you know at the time, and that if you don't have the expertise, you go out and hire expertise. So in defending against these claims, you just want to be able to show that you had a prudent process when you were selecting this strategy, and that if you didn't have the requisite knowledge at the time to select that strategy, that you hired an outside expert to help. So once again, ERISA is not a test of picking the absolute best performing option to ever exist. That's not the standard. It's a test about prudence. So again, just a little taste of the types of claims that are being filed against large corporations still today. The next section I want to move into is one that is really, really exciting this week, actually. So again, something that we've written quite a bit about on our blog and talked to clients a lot about are the cases against colleges and universities as defendants. So a lot of attention this week, given that one of the cases, the NYU case, started trial on Monday. And I'll take a step back just to kind of lay the land, and then I want to talk more specifically about the NYU case and the University of Pennsylvania case. So in total, as of today, which I haven't read the news a lot today, so it could be even more, or something could have changed by the time I'm giving this webinar, because in these cases, things are literally changing moment by moment. But as of today, to my knowledge, there are 18 cases that have been filed against colleges and universities with respect to their retirement plans. So the first group of cases was filed in August of 2016, and the most recent, and it wasn't that they were just all filed then. There was a group filed then, and then over time, there've been a few more filed and kind of sprinkled in. So the most recent cases were Georgetown, I believe, and then George Washington University, which was filed within the last week. So, you know, what are the claims of these cases? One of the things that's interesting is that some of the claims are somewhat similar, or some would argue maybe that some of the claims resemble the same types of claims, or are treating these 403B cases more like they are 401k plans. And so the argument on one side is obviously that, hey, 403Bs are substantially different than 401k plans and should be treated as such. First and foremost, because 403Bs are set up differently. They were always set up differently under the tax code, and they should be treated accordingly. There's obviously arguments on the other side, which we'll have to see what the court says. But the gist of the claims are very, very similar across many of the cases, and they include things such as too many record keepers. And the problem with too many record keepers is that you can't get the best, or not best, excuse me, but you're losing out on lower pricing when you have too many record keepers or too many vendors. Another claim is too many investment options. So the common argument there is that because there's too many investment options, then participants will become confused and paralyzed. And I think sometimes the phrase that they were using was a dizzying array of investment options. Another argument is that too high of investment fees when cheaper options were available. So this is coming up in the context, for example, of choosing actively managed funds rather than passively managed funds. And one thing to keep in mind when you're looking at causes of action like this is having an understanding of what the claims say versus what ERISA requires. So again, there's concepts of maybe best practices versus then what does ERISA, or what does the code actually say? And in this case, for example, there's concepts or arguments of what's best practices using active versus passive versus mix of both. And what does the code say? ERISA doesn't say you can't use actively managed funds. It never says that. So just keep that in mind as you start to look through some of the causes of action. Another one that would come up is no competitive bidding process for third-party service providers, or rather your vendor or record keeper. So that would be the argument, hey, when did you last go through the RFP process? Or rather, oh, you never did go through an RFP process. So that's a high-level overview of what the claims are. The two that I want to take you to just real quick would be the NYU case and University of Pennsylvania. So NYU, that started trial on Monday, and I believe it was set for a 2-week trial. So what's the big deal? The big deal is it's the first of these cases to go to trial, and none of these cases have settled so far. So this is really, really different than in the 401k space, where in the 401k space, most of these cases were settling. But in the 403B space, none of these cases, we've got 18 of them now, none of them have settled. So they've all stayed the course, which means that the outcome of this case, if it goes all the way through till the very end of the trial, it may have an influence on how some of the other cases play out in terms of settlement. That being said, all of this is very facts and circumstances dependent in each of these cases. So definitely keep that in mind, but at the same time, the outcome may influence some of the others. Also, as we've talked about a lot, in various contexts, and I think I mentioned in this webinar, there's very few cases that are actually litigated, so there's very little precedent. One of the things that I sometimes say about ERISA is that it's so great because it's flexible, but it's also not so great because it's flexible. So you oftentimes hear about best practices, but you don't really know what to do because, yeah, it's best practices, but the case law doesn't actually say that. It's all just kind of based on how the industry morphs, because ERISA, the actual text of ERISA, is really broad, and then there's no case law to ever support it because, as I mentioned, there's always these settlements. So the ability to have this case heard in its entirety and not thrown out on a motion to dismiss or a motion for summary judgment, but where all these facts could be heard and then, ruled on and actually give some meaningful case law, that could be really fantastic for us as an industry to start to have some case law. One of the things I will point out is that there was a motion to dismiss earlier in the NYU case. There was also a second NYU case filed. The second NYU case filed was thrown out, and some of the prior claims in the NYU case were thrown out. So we are just left with a more limited scope in the NYU case. Not all of the NYU cases' initial claims did continue. So, for example, I think one of the claims that got thrown out in the NYU case was that there was the argument that the contractual agreement to include certain funds as a part of the record-keeping agreement was a breach of fiduciary duty. That claim was dismissed. They said it wouldn't have been a breach of fiduciary, or the judge rather said it wouldn't have been a breach of fiduciary duty unless the plaintiffs could have shown through evidence that a prudent person would have done something different or chosen a superior fund, and they didn't do that. Two of the claims that did survive and are being heard at the trial do include the failure to get competitive bids for record-keeping services, so the failure to go through that request for proposal process, and then the paying excessive record-keeping fees, so those survived. The next case I wanted to talk briefly about is just the University of Pennsylvania case. It is the one outlier that you're seeing on the screen that was dismissed, which is very significant. However, it is now on appeal in the Third Circuit, and there are several industry groups, as you might imagine, who are writing briefs in support of the university. And part of their briefs are really striving to explain to the court what are the differences between 403B plans, for example, and 401K plans. So I know I've talked a lot about these 403B cases. I think it's important for a few reasons. One, getting the case law, but two, showing the evolution of how in this litigation, it's like we went through this phase of the 401K cases, and now about a decade later, then they shifted and said, oh, look, a new target to attack. Let's try the 403B line. So I think it's notable for that reason as well. So the next slide we're going to just quickly go to, I won't spend a lot of time here, but in the spirit of kind of new targets and where does the litigation move to, briefly just want to hit on three quick areas. One, unions. It was surmised last fall by some in the industry. And when I say industry, I just am speaking in terms of financial services industry. So if you're reading a lot of the trade press, that's where I'm referring to the industry. But it was surmised by some that union plans may kind of be the new target where the industry moves in terms of this fee litigation. This was a plan, a big plan, but it's not one of the mega plans, as I would call it. But it's a class action filed against a $900 million plan. Really Much of the same in terms of kind of the plain vanilla claims, breach of fiduciary duty for paying excessive fees to record keepers, and then use of retail share classes as opposed to lower cost institutional share classes. And we'll come back to share classes here in a little bit when we talk about the Tibble case to talk more about what that means to have payment for a more expensive as opposed to a lower price share class. So one potential target to be on the lookout for is unions. The next target would be smaller and mid-sized plans. And of course, everyone has their own definition of what a quote small plan or mid-sized plan is. But the notion is that for many years, everyone thought it was only these big plans that got sued. And if you're a smaller plan, you could just fly under the radar. So now that's not necessarily the case. As more plaintiffs' attorneys are entering the ring, as we talked about earlier, more lawsuits are being filed and it's moving down market. That being said, I really don't like the notion of just creating fear that you're going to be sued tomorrow. That's certainly not my intention with this slide, and I don't think you should operate that way. Anyone can be sued at any time. I think you just should have an awareness that it's not just mega plans that are being sued. It has somewhat moved down market. And there's a couple of cases that just suggest, $25 million plan, $150 million plan. Those lawsuits are out there. From an economic model for a plaintiff's attorney, doesn't seem to make as much sense to me, but they do exist. Finally, wanted to point out that you may have been wondering why it's always the plan sponsor being sued, or the plan sponsor as the defendant, and not some of your service providers. So why is it not your advisor? Why is it not your record keeper? Oftentimes, and there are some exceptions that are out there, oftentimes the record keeper is not a fiduciary to the plan, but with respect to the advisor, and so that could be one reason why the record keeper is not being sued. There is a line of cases relating to some kickbacks and some issues there, but that's a pretty small subset. But with respect to these kind of excessive fee cases and that sort of thing, there's starting to be potential that advisors may also be named in some of these lawsuits, because the advisor oftentimes, take Multnomah Group, for example, we are a co-fiduciary to you if you're one of our clients when we are making the selection of your investments. So we did see in the NYU case, for example, not the first case, but the second case that was filed last November, it was ultimately dismissed, but they did end up naming the advisor. So the advisor who is a co-fiduciary who is assisting them with their selection of the investments. We did end up seeing the advisor named in that case. Keep in mind the pleadings there, and when I say pleadings, the document that the plaintiffs are submitting to the complaint on that, or the amended complaint, it didn't have a lot in the causes of action related to the advisor or why the advisor is being added. It was pretty light there, so you couldn't glean a lot from it. But just something to note that in the future, some experts have suggested that maybe advisors will start to be named more frequently in some of these cases going forward. So now that we've covered, we've given a pretty good landscape of the type of litigation that's out there, the claims that exist, and their targets. So hopefully you got to thinking about how you are prepared to defend against such claims, and how you're practicing, good fiduciary practices. So now I want to turn to what I was mentioning, or calling kind of these conflicted messages. So I feel like some plan sponsors probably have this idea that, they feel like when they read these headlines, right, there's conflicted messages, or when they attend webinars and they see some of these big themes or takeaways, the messages are conflicted. So for example, this case could have been won because they use the collective investment trust for lower fees. So our plan should use collective investment trust. Or another example might be the judge in that case said that they should have used per capita as the fee model. So we should implement a per capita fee model for our plan. So what I want to point out is that there's several conflicted messages, and I want to talk about a few of them, and then talk about what you should do about them. So in one case, it's on this kind of first line of the chart. In one case, the allegation was that collective investment trust would have been a cheaper option that wasn't evaluated. And that was actually the Nordstrom case we talked about earlier. But in another case, the collectives or CITs really, in fact, had a lot of drawbacks, and that made them not the best option. So that was the argument there. And it lists what several of those drawbacks are to collectives. So if you were kind of trying to glean from that, should we use collectives, should we not use collectives, and you were just gleaning those pieces, it would feel like, well, wait, what should we do, what should we not do? Another example on kind of the second line of the chart, money market versus stable value. And I think this one comes up a lot. And check out the article and the citation that I pulled from, because that's a really good article on this specific example of collectives versus stable value. But the idea is that the argument in one case is that money market wasn't the best option and stable value would have been better. However, on the flip side, another case says that the stable value option was too risky. Let me take one more example. So finally, let's look at some of these recent 403B cases where there's so many examples from my perspective of conflicted messages if you start to look at all the various motions to dismiss, which were happening in a lot of the lower courts, so the lower district courts. So because not all the cases, those 18 cases, they're not all being heard by the same court. They're different courts hearing these cases. So in some of those cases, the judges are allowing the claims to proceed, saying that there's too many investment options in the plan, which actually will confuse participants. So sometimes those claims are proceeding. But on the flip side, take the Yale case, for example. The court actually dismissed that claim and said, no, you didn't point to a single participant that was actually confused or paralyzed by the number of investments. So because you couldn't point to a single participant who is confused, we're throwing that claim out. That does, no. So my point is, when you're in a webinar like this, or you're reading headlines and trying to keep up, because there's so much different litigation out there, I think it's important to really take with it a few things to keep in mind. So first and foremost, these cases are highly facts and circumstances dependent. The outcome of these cases can change based on one single cause or one single fact, or it can also change dependent upon what the plaintiff's counsel, like really just good attorney, right? Or good drafting by an attorney. So if, their private investigator is able to actually find the 5 participants who can put in a testimony on the fact that they actually were confused, well, maybe they were able to get that claim to proceed. So the point being, it's super facts dependent. And so you can't just kind of take from the headlines what may seem to be conflicted messages, because it's really the theme of the headline that counts, and then you've got to apply it to your specific facts and circumstances. So I just wanted to point that out. Also, keep in mind that ERISA requires a prudent process. So as I think I mentioned earlier, many of these cases are filed without knowledge of the process, but with hopes about learning the process through discovery. And when we use the term discovery, that's really just the trading of documents in the early parts of the lawsuit. So after the initial complaint is filed, then the parties start trading documents, and that's where more information is actually found out. But initially, it's really just a shot in the dark based on the public information that's out there, based on, for example, 5500 data and that sort of thing. So to really get into the process part of it, you've got to get to discovery. So again, some of the initial lawsuits are filed and they get to a settlement. We don't actually get into all of those facts. which goes back to why NYU and it being heard through an actual trial could be really helpful. That kind of leads us to the next point, which is that most cases settle. So the claims you see in the complaint may or may not have any merit if they actually were to make it to trial and for the case to be heard in its entirety. Finally, one point I wanted to make is just, the court standard for a motion to dismiss. I included that just so that you get a sense of what the standard is for a motion to dismiss. There's various stages before you get to trial where you can either eliminate some of the claims or then get to a motion for summary judgment where the claims, the lawsuit rather, could get thrown out in its entirety. So again, putting on your defendant hat, you want to be thinking about what is it that you could have in your arsenal or your fiduciary file to really amass the evidence or the documentation to say, hey, I realize by having a plan, I could get sued at any time, but if I do get sued, I'm going to win, and I'm going to get this case to go away really fast because I've got all my documentation ready. So a few things I just wanted to think about. I know we're starting to get a little close on time, and I want to save some time for questions at the end, but I cannot stress enough that ERISA is about a prudent process. And to be able to demonstrate a prudent process, you have to have evidence that you engaged in a prudent process. I want to take one kind of sidestep to remind you what a prudent process is. So keep in mind a prudent process, because I think we say it all the time, but we don't even think about what that really means. But a prudent process is following an objective process, reviewing relevant information, and that's all relevant information or that which you should know to be relevant, then conducting a meaningful comparison of that information and arriving at a well-informed decision that is documented. And that applies to whatever decisions you're making as a fiduciary related to the retirement plan. So it doesn't matter if it's an investment decision, if it's dealing with things related to the administration of the plan or selecting a vendor, you have to show a prudent process. So this slide, I'm not going to read it to you, but it just points out some of the things you may consider that you want to be able to produce to show your prudent process. So we've talked some doom and gloom. We better save some time to talk about success for plan sponsors and the bright spots and where that success came from. I think one of the big successes came in the case of White v. Chevron. So the Chevron case, it was, basically plaintiffs got 2 bites at the apple and they failed twice. So the plaintiffs, they argued that, trying to use essentially a hindsight argument, that, had the plan, if the plan included mutual fund share classes, if they would have had the lower price share classes, they would have been better off, and that if they would have acted more prudently in their selection of funds, then they would have had higher returns. So, they can look back and say, well, yeah, if you would have done this, then it would have been better off. But that's not what ERISA requires. So the court, they dismissed plaintiffs' arguments, and the court said, and I bolded this because the court said the question is whether the fiduciary engaged in what we just talked about, a reasoned decision-making process, and it's all about that prudent process. And they said that, a fiduciary may act reasonably in selecting the investment alternative in view of its different risk features, even if that investment option turns out to yield less than the other options. So I really want to emphasize that. It's okay if it turns out that the investment didn't perform as well as a different investment in the end. But the analysis isn't to look back and say, hey, what performed better or could have performed better. It's to look at what was the process that was followed. Do you have documentation of that process? And if so, then you've met the standard. And that's what happened in the Chevron case, and that case was thrown out accordingly. So that was a good success for plan sponsors. The next case that I want to point out that was also a success for plan sponsors really deals with why it's important to send out notices. So we've been talking a lot about fees. We've talked a lot about, I think, selection of vendors. What we haven't spent much time on this webinar is from the administrative side. So from an administrative side, that's also important and can be a source of shielding against litigation. So this is a case that really demonstrates that importance. Here, the defendants provided all of their notices and had evidence of the notices that they provided, which included the annual fee disclosure notice, the quarterly fee disclosure notices, targeted emails, a website for participants. And because of that, this argument that participants were enrolled in these risky funds, that didn't stand because they were given notice. And so based on actually a statute of limitations argument, they were able to have the case dismissed because under the statute of limitations argument, they were able to take it down to a 3-year statute of limitations because of actual knowledge, because the notices were provided. And so they were able to get the case dismissed on a motion for summary judgment there. So again, the importance here is that plan sponsors can win. They are winning some, and here they're winning because of just simply providing their notices and keeping documentation that they've done so. So as we get towards the top of the hour, I want to make sure I get to a couple more slides, one of which is the fact that we want to show lessons learned from the Supreme Court. As I mentioned, not very many cases are litigated. One case that has been litigated and made it all the way to the Supreme Court. It only took about a decade to make it to the Supreme Court and back and finish last, I believe, August in the district court. So that's that lower court. Was the case of Tibble v. Edison. A few things, and I won't go over all the facts of the case, but a few things that you can really take away from this case. One, you have a continuing duty to monitor investments. You cannot pick the investments and then consider your job complete. There's an ongoing duty to monitor, and your liability for those investments, it's going to keep going for the duration of when you have those investments. Good, bad, or indifferent, that's your continuing duty. You also have a continuing duty to monitor share classes. So we could do an entirely separate webinar on share classes, and I think we either have done one recently or will, but you, just like investments, there's also this related concept of share classes for those investments. So the gist of share classes are that you have a single mutual fund, and it may offer more than one, what I'll call class of its shares to investors. So each class represents a similar interest in that same mutual fund's portfolio. And the main difference between the classes is just the cost. So what this case says, or what I take from the case, is that you have an ongoing duty to review the share classes. And while the case doesn't say you have to go at the lowest cost share class, I would venture to say that if you're choosing higher cost share classes, you should have a good reason for it and you should document it. So I'm not saying you can't do it, you just need to document why. Then finally, the third point I'll make here is that you should meet regularly to review investments in share classes, as well as other, several other things that you need to be doing on a regular basis. But this case is, specific to really addressing investments and really related issue of share classes. And you should document these meetings. So the case suggests that meeting once per year might not be enough. And then if you take a long time to implement the changes you've decided on at the meeting, that would certainly be insufficient. So I want to hit on 2 slides worth of tips. We don't need to really go into detail on these, but I'm just going to tick through them. I divided it up into tips related to plan governance and tips related to plan operations. And again, I would ask that you take these in terms of considerations, because there may be reasons that some of these don't fit your plan or your culture at your organization for some reason or another. These are just, as I've mentioned, based on ERISA and what we can glean from the litigation that's out there, what the industry has moved toward and considers best practices. And you should really just use these as consideration points for your meetings, and then you should document accordingly. And one that I failed to put on these slides, but I think you should work with your insurance brokers on, and so this is a bonus for people who are listening and not just looking at the slides later, but insurance should be included as a tip somewhere on one of these two slides, probably the operations one, but making sure you have the proper fiduciary liability coverage that's comfortable and works for your organization. But aside from that, I'm just going to tick through these. So make sure to consider things such as ensuring that the proper delegation documents are in place. So most commonly, we're seeing those as some sort of fiduciary governance charter or committee charter rather. So make sure you've taken a look at those. Also, once there has been some sort of delegation, make sure there's routine monitoring for whoever's delegated. So, and even if you have a board that's delegated to a committee, which is what we see most frequently, make sure that the committee is reporting back to the board occasionally. We don't want a board that has no idea that they have any relationship to their committee. Be sure to meet regularly and document meetings. That should seem obvious, but may not be. Engage in periodic training of the plan's fiduciaries. I think that's one that is critical, that everyone understands their roles and responsibilities, and if they don't, that we get them the right training, and that should be an ongoing process. Next, ERISA is very clear that you don't have to do it all yourself. You can certainly hire outside experts, and it's certainly a reasonable plan expense as long as you're paying reasonable fees for it, that those could be paid out of plan assets. Be sure to utilize an investment policy statement. I will caveat that by saying ERISA does not require an IPS, but we find that a lot of well-run committees use an IPS, and then of course periodically look back at it. Don't have a document you don't look back to. The last point I will make there is don't over-policy your plan beyond what your plan is prepared to administer. Policies are fantastic, and you should implement them where you find appropriate. So for example, if you want to have a fee policy statement, that can be great. But I recommend having 5 different policies that you can't keep up with, because what ERISA really is not, or what the Department of Labor is not in favor of, is having a bunch of policies you don't follow. And Plaintiffs' Counsel will particularly love a plan that has a bunch of policies they don't follow. Those will make great exhibits. I'll end on this slide, which is from the plan operations perspective, a few more tips to consider. Part of these come from some of the litigation we talked about on that 403B page, and then as well as the ones that were against the corporate defendants. So benchmarking your record keepers fees. Make sure you're engaging in some fee benchmarking or documentation that shows, hey, we've looked at this vendor's fees. Just going through an exercise to formalize that and putting it in your meeting minutes is fantastic. Periodically going through an RFP. An RFP process, I think some people become resistant because they feel like that means they must choose a different vendor at the end. It doesn't mean you have to have a different vendor. It just means you need to at least go through some evaluation process at some point. Next, make sure you understand the method by which participants remit fees. So there is a movement away from, there's arguably a movement away from asset-based pricing toward per capita pricing. But again, part of that depends on the size of the plan and what works best for your plan. So I offer this up as a consideration, not a you must go back to your office and do that immediately. Next, I would suggest routinely monitor investments and update when necessary, as we were just discussing with the Tibble case. Another consideration, again, do what's best for your plan, but a consideration just to consider non-proprietary investments. That kind of comes from some of that 403B litigation we were just talking about. And also implement, this one I think is critically important, but implement a fiduciary program to ensure all fiduciary responsibilities are met. Here, it's really just about having something, call it a calendar, call it, you know, a task grid, or whatever you want to call it, an Excel spreadsheet, something that says, here's the stakeholders, here's the timelines, here's who's doing what to make sure we're getting everything completed. So with that, I think we will conclude the webinar and take any questions. I know we covered a lot of ground. I really, really appreciate everyone sticking with us through the entire webinar, and thank you so much for the attendance today. So with that, we'll open the floor for any questions the group might have.
And just a quick reminder to everyone, if you do have a question, use the Q&A function in Zoom to ask Bonnie any questions.
Lindsay, I'm seeing one question pop up. Do we expect any? We did receive one question, and I think I understand what it's getting at. It says, do we expect that 403B accounts will become subject to fee disclosures? If I understand the gist of the question, we may have to have the person respond with additional feedback, but the fee disclosure regulation that I was referring to earlier, the 408B2 and 404A5, I do think I referenced that in the context of the 401K litigation, but yes, 408B2 and 404A5 does also apply to 403B. So that's part of ERISA. And so any ERISA covered account, I am saying that generally, I think there are some small exceptions, but ERISA covered 403Bs are also subject to 408B2 and 404A5. And so a quick refresher on what those are. 408B2 is a regulation that says that covered service providers, and when we say covered service provider, that's anyone who is being paid $1,000 or more annually out of plan assets. Anyone who's receiving $1,000 or more out of plan assets in a year, they must give a disclosure to the plan sponsor that says if they are a fiduciary or not, what their fees are, and what their services are. And they have to do that initially, and then upon any change to any one of those three things. The kind of, I'll call it like sister disclosure to that is the 404A5, and that goes from the plan sponsor to the participant. When I say it goes from the plan sponsor, most plan sponsors have outsourced that to their record keeper to do. So that requires both a quarterly, so like the quarterly statements that go out, as well as an annual statement that goes out, and that's disclosing the fees that participants are paying. So those are, for ERISA covered 403Bs, those disclosures do apply. That was a great question. And if I didn't get the question right, feel free to type back in and I can clarify further. Any other questions that have come up? One question that we're getting quite a bit is with respect to the fiduciary rule and whether we'll expect to see litigation there. At this point on the fiduciary rule, we originally felt like there would be, as part of kind of what I was referring to as changing regulations, which will create litigation, we felt like, and I think a lot of industry experts felt like, there would be an increase in regulation as a result of the fiduciary rule, given that we would have so many financial professionals now acting in a fiduciary capacity who are not previously acting in a fiduciary capacity. But given what's happened recently with the 5th and the 10th circuits, and the fact that we had one of the circuits, and when I say circuits, so the lower court, one of the courts say, no, the fiduciary rule cannot be upheld. The Department of Labor has went beyond their authority in creating this regulation. Given that that's happened, and we're now waiting for the Department of Labor to see if they're going to appeal or not, I would expect that we'll pretty quickly see that the Department of Labor, this is just my guess, it could be entirely wrong, will not end up moving ahead and going on appeal there. And we'll see the Department of Labor, that rule initially, or basically just fall apart, and we won't have it. So I think what we would have seen as increased litigation there, predominantly against financial service providers, which would kind of be a new target and area of litigation, I would expect that will really fall off the tracks, and we won't see that going forward. So what would have likely been a large source of litigation, I think, will ultimately not become a source of litigation in the near term. Lindsay, I'm not seeing any other questions come in unless you are.
No, we've only received the one.
Perfect. Well, I think with that, we'll go ahead and conclude the webinar. Lindsay, thank you so much for hosting the webinar today, and thank you so much to everyone for their participation in the webinar.